In this video, we'll discuss about 10 non-technical and non-numeric factors which determines our investment decision in the market, which controls our investment decision in the market. See, when we make financial decisions in the market, we take those decisions to maximize our returns and optimize our performances in the stock market. At least that's what most of us would think. Most of us would say that this is correct. This is the correct way of thinking. This is exactly what we should be doing. But in reality, is it just only the numbers? Is it just only the profits or the calculations that matters? Or is there anything else that actually controls what we do in the market? I think they are. They are the emotions and the biases. We all run after the numbers. We all run after the company fundamentals and technical analysis, charts and figures, statistics. But the factor which is even more important than the statistics is how you control your decision when you find something very much attractive, when you find something which is conducive for you to put in your money. How do you react to a given situation? If you're aware of them, it'll help you take wonderful decisions and prevent massive errors and prevent making massive errors in the market. Number 1, mental accounting. See, regardless of the place where money is originated from or where it should be spent, money as an overall, all money is same. So it's people who put a worth on a product or on a service, even though probably they might all have the equal cost. They might cost the same, but the worth that you or me get out of a product or a service might be different. And that's how we place an importance to a product or a service. How you look at things, how people, they continue to pay high interest loans and yet keep loads of cash in their savings account. They pay an interest of 10-15%, and instead of paying off that loan, which is withdrawing 10-15% interest every year from them, they're keeping money in savings account, which is getting them 2-3% returns. That's how they react. That's how people react to money. People still use credit card. They still pay the minimum balance. They know credit card charges the highest interest rates in this world. They know credit card charges the highest interest rates, 30, 35, 40% to some extent. And yet, they do not pay off the credit card. How surprising it is. It's really surprising that people still feel that saving for a down payment for a new house or maybe having some cash at hand in the savings account is far more important than paying off the credit card debt. It's so surprising to see people behaving and reacting in these lines. So logically, even though it's very much logical to pay off the high interest rates first, people still prefer to keep cash at hand. And after all these, people tend to attach a far more value on products or services they actually own. They start associating and expecting a higher value on the products they have actually invested in. And finally, in the end, when you think of selling off your house or your car probably, and you don't get the value that you're expecting out of it, you feel sad. So what is the solution? The solution is to have a nice budget, to have a budget that can provide a good amount of cash flow to be able to pay off these high interest debts. Number 2, the herd mentality. See, there is a very, very common belief that someone can fool you once, twice, thrice. Probably someone can fool a short group for a short period of time, but it's very hard to fool a mass number of people, a huge number of people for a very, very long time. The concept of herd mentality starts here. You start to believe, you start thinking that since a mass majority of the people cannot be fooled for a very, very long time, so what's happening probably might be right. And this is the reason why you start following the herd. Because you feel it's right, because you feel when so many people have believed in an event and has reacted in a particular way, that probably is right, because I may not be that smart. I may be the odd one out if I react in a different manner. Will I be taking a wrong turn? Will I be making a wrong move if I don't follow the herd? Now you start to develop an emotional conflict within you, which is against the herd. You versus the herd. This is known as cognitive dissonance. This allows you to choose restaurants which are flocking with people over restaurants which are empty. Even though you probably would like the food in one of those empty restaurants, you can go and sit there, you can have a food, you'll probably say this is nice. But you don't go and try it out because you feel there aren't many people here, so the food might be bad. So you go to a place where you see a number of people flocking there. At an instant it tells you, okay, this restaurant might be very good because there are so many people around it. You tend to choose a stock based on a text analysis report. You probably log into any one of those finance sites and see a tech recommendation and probably make up your mind to buy that stock, because that's what the tech has recommended. Instead of you doing the proper research, you go by what the tech has said, and probably the mass majority would do the same. They would go by what the tech analyst has said. The analyst has recommended a 90% buy for a particular stock. So why put your head into stress? Go and buy what the tech has recommended you to buy. And that's what you do. That's what most others would do. And that's why you buy. That's why the herd buys the stock and you also buy the stock. You go by the herd. Now, what's the problem in doing this? The problem is this can create massive bubbles that can burst. The best example is the 2000 bubble. When everyone was buying, it did burst at a point. The dot-com bubble, the real estate bubble, all of these are examples where the herd mentality has proven its point. That when you put in your money in a thing and inflate its value, it's going to burst at one point of time. So what is the solution? The solution is not to blindly trust what others are doing. I'm not saying don't follow the herd. Follow the herd if the herd is right. But you have to do the analysis, you have to do the investigation to know whether the herd is right or wrong. Only then you take a decision to move towards the herd or away from the herd in an opposite direction. Number 3, avoiding losses. It's the tendency to prevent losses than to acquire equivalent gains. So to avoid loss, you at times do not enter a trade, or probably you at times sell off a holding at a much lesser profit just for the fear of it bouncing back, just for the fear of it coming back and hitting at you saying, this is probably the best price that I was in, and if you are not selling it off now, I'll bounce back and you'll be at a loss, and that's why you sell it off quickly. But rather than you find the stock has moved up substantially after you have sold. You sometimes buy a security, maybe a real estate or maybe any product or any service or anything, any investment option, any stock or bonds or anything, whatever. You've purchased it at a particular price and you have it in your mind that I'll not sell it off below my purchase price. That's a blocker in your head. You do not want to incur the loss. You want to avoid the losses. No matter what happens with it, the stock plunges, you still feel that one day it's going to bounce back. One day, when, I don't know, when you also don't know, but you still feel that someday it's going to bounce back. So you hold on to it. You know what the problem is? The problem is it avoids, or it causes us to avoid smaller risks. Even we know that putting money in a savings account is actually eating up our capital. The inflation is eating up our capital. We know that. Even then, we still tend to put in money in a fixed deposit or probably in a savings account to avoid the volatile market, to avoid losses in the stock market. Even though we know that investing for a long term would probably give you a much higher returns than traditional fixed deposits or savings account returns. We know this, already we know this, but still we want to avoid the losses. What is the solution behind this? The solution is, this is just a mindset. Stop behaving or stop believing that what you're thinking is right. That is wrong, absolutely. Shift your mindset, start a new way of thinking, start putting money into investments and see the returns for yourself. It's a mindset change which you need to bring for yourself. Number 4, sunk cost. A sunk cost is something which has already gone. You cannot get it back. It's something like you purchased a match ticket. Maybe you wanted to see a cricket match in Eden Gardens, and you have the ticket with you, but unfortunately on the day of the match it's raining since the morning, and the match is cancelled, or probably the players were out for maybe an over or two and the match got cancelled, and the ticket will not be refunded back. That was the clause. You cannot take this pain. Sometimes you buy a real estate or you buy a piece of land that has gone down in value. Sometimes you buy a stock that has gone down in value. You cannot bear the pain. It's gone. You sometimes hold on to businesses because of your emotional connection to it. You don't want to let it go because probably the business was started by your grandfather, your father, you had your entire family involved in it, or whatever it is. There might be numerous reasons for it. But whatever the reasons are, you still stick with it. You tend to bind your emotional feelings with an investment, and at least for something which you have already paid for it. This is the problem. The solution is to come out of this mindset. Untie your emotions with your investments. Do not love your investments. Yeah, they are required. They are very much important for you, but don't love them. Do not fall in love with the stock. Do not fall in love with a bond or any security for that matter. But use them for your profits. That's all. That's the only concept. That's the only truth about investing. Let go of the sunk cost. Number 5, the gambler's fallacy. It's about seeing patterns that do not exist. You tend to seek patterns, to believe in the law of averages, to believe that you will definitely get a good luck after a series of bad luck in the market. To believe something will change is your fallacy. So the problem is, you believe in the law of averages. You feel that, okay, every time it cannot be this, it has to turn around. Yeah, it's true, it does work, but the real problem is we don't know when it's going to work. You might say Pareto was there. He said it's 80-20. Yeah, he's right, but by the time you cover up the 80%, you'll be probably out of the game altogether. So the solution is, do a thorough research and investigation on or about your investments. Do not rely on anything else. Do not rely on any news or any other information coming from anywhere else. Do not rely on unseen patterns or assumptions for that matter. See what is there, see what is visible, and don't see what your mind wants to see. Number 6, the illusion of control. It's the tendency to overestimate the ability to control events. Now you start feeling overconfident when you start believing that you have control over outcomes which probably you cannot influence. Now this makes traders trade more frequently than they should be trading. The problem is, this is the overconfidence bias. This bias allows you to make trades or allows you to take decisions which you shouldn't be taking at that moment. It allows, or it makes an investor or a trader to overestimate their knowledge or their abilities. So what is the solution to this? The solution is, come out of this mindset, go and do a gut check on your investment. Go to a financial advisor, seek his help, try and understand what's going wrong. Take a viewpoint, take a third eye, get a fourth viewpoint, fifth viewpoint, and then probably you'll be able to say, okay, fine, the decision that you have taken is right. Involve a team to help you in your investments. Number 7, paradox of choices. Too many choices spoils the broth. If you have too many information available with you, it'll actually confuse you a lot. It'll confuse you a lot more than anyone else in the market. It'll confuse you more than the people who do not have exposure to the kind of information that you have right now. Barry Schwartz wrote a book, The Paradox of Choices. He said in this book that if you eliminate the number of choices that we give to our consumer, that will greatly reduce the anxiety for the shoppers. In businesses, when businesses try to acquire products or maybe get the raw materials from different suppliers or this and that, they tend to stick to one particular supplier. They do not want to move to 10 different suppliers and get to choose something from someone else. At the most, they try and outsource this department altogether because they do not want a headache of different choices. Rather, it's more beneficial if they can focus on their own core business rather than finding out the best deal out there in the market. And so as a solution, they stick to one particular supplier. See, this is the problem. More confusion leads to more problem. The solution is to stay away from this noise. If something is working for you already, stick to it. Do not change it. Number 8, confirmation bias. I think we discussed this in our previous videos, but in short, confirmation bias is something when you tend to find a proof of what you have actually started believing in. When you believe in something, you hold on to it, you anchor that belief, and you start finding small proofs that can support your belief. That can say, okay, I believe this because this is what I have seen, this is what I have seen, this is the proof, this is it. That is confirmation bias. The more information you get, the stronger hold you would have on your belief. No, this makes, the more information you get, the more concrete your belief becomes. The more you start believing, you start becoming confident, and slowly, the confidence turns into overconfidence. Number 9, anchoring bias. It's about relying too much on pre-existing information that was given to you or the information that was provided to you firsthand. Companies use this to market their product. Probably they place a high priced product first and then they reduce the price and say, okay, fine, this was the price earlier and now this is the price, this is the new price. When that happens, a customer feels, okay, fine, this is probably the reason I got a very good bargain. I was getting it for 1,000 rupees, now I'm getting it for 800 rupees. I just made a 20% profit straight away. It's not just about the price of a product, it's about your salary negotiation. Probably when you are negotiating the price of a contract with a client, everywhere you'll find this. In investing world, investors anchor around a price. They say, okay, fine, this is the price that I'll be entering the market when it reaches this. And you anchor yourself around that price. If the stock reaches at this price point, then I'll buy it. If it reaches here, I'll be selling it off. Now the problem is, with so many things happening around you, you only get more confused. You would require complex judgment to identify the right purchase. It's too complex. So you stick to your bias. That's it. So the solution to this is do more research and accept the asset's final price. It might happen that the asset price might have fallen below your purchase price. That's okay, because that is a new information. That is an updated information. Do not hold on to your previous price points. Number 10, emotions. Emotions influence a lot of financial decisions that we take in the market. So when you're in a good mood, when you're happy, it increases the probability of taking more risk. You increase your capacity of risk taking. And when that happens, you trade on the spur of the moment. You probably do whatever it feels like. You sometimes go right, you sometimes make a mistake, and it doesn't bother you at all. And when the mood is down, you're in a downward market trend, it's bad. You feel the pain. The market is a roller coaster, so is your emotions. And that's why you see when the emotion in the market is good, the market is on the rise because people are buying. They are happy, they are buying. And when the emotion is on the downward trend, when people are not happy, they are selling off. They're not buying, they're probably not involved, they're not interacting in the stock market at all. And so the market is probably flat, or maybe it's falling. You know what the trick is? Every company who manufactures a product and sells it in the market, they use this technique to make the consumers buy their product. Have you seen any product which is advertised with a person sitting idle, or maybe is very sad or something like that? No. You'll always find the person who's advertising the product is smiling. Probably he's excited, he's happy, he's jumping around, and he's super duper excited with the product. You'll never say, okay, I got this, what will I do? No, you'll not be able to sell your product with this emotion. So that's the trick that every company plays on you. If they can catch your emotion, they've got you. They can sell you anything and everything that they produce. As a solution, you have to be alert always. Do not fall in this trap, in this emotional trap. The advertisements will trigger your emotions, but it's then that you'll have to be very, very cautious and probably hold on to your nerves. That is the moment when it'll be a deciding factor whether you are falling for this emotion or you're not. Evaluate your value points, evaluate the use case, the reason why you want to buy the product. And if you really need it, then go ahead and buy it. Do not just buy it because someone has triggered your emotion, someone has triggered your happy emotion. Don't take an action based on that. So these are the 10 non-numerical factors which plays a very, very important part in the market. And if you can master them all, I believe you can have a very happy and a safe investment journey. That's all for today. Stay tuned for more such videos. Like and subscribe this channel, and I'll bring you more videos on such topics. Till then, SG signing off. Goodbye.